Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AGNC Investment Corp. Quarterly Report. AGNC Investment Corp. offers a range of businesses and services that cater to the housing market in the United States. The company's primary activities include investing in residential mortgage pass-through securities, investing in collateralized mortgage obligations, providing private capital to the housing market qualifying as a real estate investment trust, REIT, for federal income tax purposes. These services enable AGNC Investment Corp. to generate revenue while minimizing its corporate income taxes through distribution of taxable income to stockholders. The recent surge in AGNC Investment Corp. stock price can be attributed to a combination of favorable macroeconomic factors and strong company-specific financial results. A shift in the interest rate landscape, with the Federal Reserve lowering federal fund rates, has led to a steepened yield curve and lower cost of funds, enhancing AGNC's profitability outlook. AGNC's robust financial performance, including strong net interest income and growth in its net book value, has also contributed to the stock price increase. The company's expanding mortgage-backed securities portfolio benefited from falling interest rates, driving a 6% quarter-over-quarter growth in net book value. Additionally, AGNC's generous dividend yield of 14.2% provides downside protection and supports a balanced return/risk profile, attracting investors. Overall, the improving interest rate environment, strong quarterly earnings, and attractive dividend yield have contributed to the significant stock price appreciation for AGNC Investment Corp. over the past year. The primary drivers of revenue growth or decline are primarily driven by investment activities. Specifically, the growth in investment securities repurchase agreements, U.S. Treasury repurchase agreements, and reverse repurchase agreements have contributed significantly to revenue increase. Additionally, derivative instruments such as interest rate swaps and options, TBA securities dollar roll income, and interest earned on investments also play a crucial role in driving revenue growth or decline. Net income and profit margins. A mixed picture. The financial performance of a company has shown mixed results in terms of net income and profit margins. For the 3 months ended September 30, 2025, net income increased to $806 million from $346 million in 2024, indicating a significant improvement. However, for the 9 months ended September 30, 2025, net income declined to $716 million from $741 million in 2024. Profit margins have also fluctuated. The net interest income margin improved significantly, rising to 16.3% in the 3 months ended September 30, 2025, from -8.5% in 2024. However, it decreased to 18.1% for the 9 months ended September 30, 2025, compared to -4.6% in 2024. The net income margin also showed a mixed trend. It increased to 9% in the 3 months ended September 30, 2025, from 7.8% in 2024, but declined to 10.1% for the 9 months ended September 30, 2025, compared to 11.2% in 2024. The reasons behind these changes are not explicitly stated, but they may be attributed to various factors such as changes in interest rates, market conditions, and operational efficiency. The company's financial performance indicates a strong ability to generate positive operating cash flow, with net cash provided by operating activities reaching $525 million in 2025 and an operating cash flow of $21 million for the first 9 months of that year. It is clear that the company is successfully managing its finances and generating sufficient cash from its operations. The company's debt level has increased slightly from $60.798 billion in December 2024 to $74.152 billion in September 2025, indicating a moderate rise of approximately 13%. Conversely, interest expenses have shown a mixed trend. While the economic interest expense decreased significantly, the overall interest expense as a percentage of total debt increased from 2.33% in 2024 to 2.71% in 2025. The company's financial performance reveals a strong showing in certain areas. The financial industry and commercial segment, known as FICC, demonstrated an impressive risk management strategy, with less than 8% of tangible stockholders' equity at risk as of September 30, 2025. Additionally, the central clearing exchanges also performed well, with an amount at risk with any counterparty to derivative agreements constituting less than 1% of stockholders' equity during the same period. These results indicate a high level of financial stability and prudent risk management within these segments. Management's outlook and strategy. The company aims to generate long-term stockholder returns with a substantial yield component by distributing 100% of taxable income and operating as a REIT. They have a constructive outlook for agency RMBS, driven by macroeconomic dynamics, improved investor sentiment, and strong financial market performance. To manage risks, management employs an active strategy that is dynamic and responsive to evolving market conditions, utilizing careful asset selection, due diligence, performance monitoring, and hedging with derivatives. The company's liquidity and capital resources are sufficient to meet obligations and execute their business strategy. They are shifting their asset portfolio from lower coupon holdings to higher coupon specified pools, while maintaining a stable leverage ratio of 7.51 to 7.61. Management will issue common stock when accretive to tangible net book value or earnings, but typically avoid issuing preferred equity, with costs exceeding acceptable hurdle rates of return on their equity. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has a history of paying dividends to its shareholders, as confirmed on multiple pages including page 3 and page 14. Secondly, the company has also bought back shares from the market, as stated on page 65. There are currently no concerns regarding inventory buildup or supply chain disruption, as indicated in the financial summary. This suggests a well-managed and efficient logistics system, allowing for smooth operations without any significant disruptions. That concludes the financial summary for AGNC Investment CORP. Feel free to comment below, and I will be happy to answer them when possible.